Getting ready to buy or sell a home in 30, 60, or 90 days? Then check out bundleselect.com to find out how you could save 20% or more on your entire transaction. Save on real estate, lending, and title. With bundleselect.com, technology and a personal concierge are at your service to save you time and money. Bundle Select's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling all of these services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. Act now, and this new model could save you money on your move, lower your interest rate, or cover your closing costs. Visit bundleselect.com. That's bundleselect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Kuchera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Kuchera.
Welcome in, Joe Kuchera with Real Estate Radio Live. Thank you again for tuning in. For those that are following us on Facebook, thank you very much. Continue giving us your feedback, comments along the way. We love that. Appreciate that very much. Remember, for more information, you can always go to RERL-1500-Understanding. We'd love for you to download the podcast. That's the way you're really going to get the information on a regular basis. That way you can stay in tuned with the show. You could do that by going to iTunes and just type in Real Estate Radio Live, or you could go to our website, RERL-1500-Understanding. Most of you know the focus for almost 8 years now has been education and information. What we do here at Real Estate Radio Live is work really hard to have great guests like we have today, good content, information. For what purpose? The purpose is to educate and inform the consumer and give you more power to make decisions in and around real estate. That's the focus, and we'll continue to bring on more and more guests to help you get to more educated. So with that, let me invite my guests in today. First, we have Doug Duncan, who's with Fannie Mae, the Senior Vice President and Chief Economist for Fannie Mae. Doug, welcome in.
Thanks for inviting me.
Good to have you. Always good to have Doug. And then Geraldine, most of you, if you've been following the show, she's a guest every once in a while and will be on more and more coming forward here in the near future, won't you?
Hi, Joe.
Yeah.
Good to be back.
Geraldine Barry is an associate. She's in the real estate background, a lot of investment. She's started a couple of different companies, and we're going to have more and more over the next couple of months. We're going to have Geraldine on, and she'll share with you some of the exciting things she's working on. And she's here with us today to do a little co-interview with Mr. Duncan here. So, Doug, welcome back in.
Thanks.
Maybe the best way to start, I think, is if you could, Doug, give us a little idea of your background and then maybe your roles and responsibilities with Fannie Mae.
Sure. In terms of employment, I spent 15 years at the Mortgage Bankers Association, so really working with the lenders that most of your consumers who have gotten a mortgage will have faced off. And then about 10 years ago, almost exactly 10 years ago, I moved over from the Mortgage Bankers Association to Fannie Mae as chief economist. So now it's sort of the back end of the mortgage company, which has actually been really interesting working in both places and kind of getting to know how the whole system fits together. And, of course, Fannie Mae, the best way to think about Fannie Mae and Freddie Mac is that they're really large insurance companies. So we don't actually meet a consumer, but what we do survey consumers because we want to understand what they're going to be looking for from our lender partners. And so they'll meet a lender, and then the lender will either sell us the loan, which we put in a package with other loans, and then sell off a security to investors backed by those loans and the monthly payments that the people who have the mortgages pay. Or else a larger lender might bring us a package of loans and ask us to guarantee the payment on that to investors. So we're really, the best way to think of us is as a large insurance company. The other firm you might hear about is Ginnie Mae, which is a wholly owned government corporation that does the same thing for loans that are insured by the FHA or guaranteed by the Veterans Administration. They focus on those kind of loans.
Okay. So you work directly with the lenders nationally.
But yet you do take information and feedback from consumers. You want to know what their thoughts, what's going on from their perspective as they work with the lenders?
That's right. To refer to something that would be familiar in Silicon Valley, by a computer, it has a thing on there that's a little tag that says Intel inside.
There you go. Yeah.
Ooh.
Intel doesn't sell anything to consumers.
Good point.
They sell chips to people who sell devices to consumers. So you can think of us at Fannie Mae as Intel inside. That's what the way we would.
I like that.
That's a very good analogy. But give us kind of an overview, if you would, of the economy, maybe just kind of a high level. There seems to be a lot of volatility, although a lot of people would argue that, boy, jobs seem to be doing well, the economy seems to be rolling along pretty well. What's your kind of take on the economy in general, maybe today, and then where you see it moving us through the rest of 2018?
Well, we think this year the economy will grow about 2.75%, which, given the resources that we have and the global economic conditions, is a pretty good growth rate. It's not gangbusters, it's not 4%, but it's difficult to see how you get to 4% with the low level of productivity growth that we've been experiencing for the last few years and the low level of business fixed investment that took place over that time period. Plus, absent immigration, our demographics actually are that we're not having enough babies to replace our population. If you add in the immigrants that we have, then the answer is yes, we do have a good demographic profile. So the 2018 should be a pretty good year economically. As for the volatility, one thing to note is that it was an explicit objective of monetary policy for the last few years to remove volatility from the marketplace.
Okay.
But most economists would tell you that some volatility is a good thing because it leads to price discovery. And in our market-based system, the price is a discovery mechanism that people, buyers and sellers, trade off based on what they know about risks and returns. And so some volatility gives a range of views in the marketplace of what different assets are valued at. So the removal of volatility, from our perspective, disguises some price discovery opportunities. So we think some of that's good. In terms of the current Federal Reserve, I think that a question for Governor Powell or Chair Powell relative to Chair Yellen or Bernanke or maybe Greenspan, who started this with what was called the Greenspan put, is if the market falls a certain degree, they're going to prevent it from falling further. I would say under the current chair, it's unlikely unless there is significant evidence of systemic institutional failures when the market declines that he would be unlikely to step in.
Okay.
Much more. His background, for those who might not know, he's an attorney. He was with the Carlyle Group, set up their industrial mergers and acquisitions business, or participated in it anyway, which means he has a good sense of the institutional structures within our economy. Then he was at Treasury for about 5 years, so he gets that side of our funding mechanism. And then has been at the Fed for about 5 years. Yeah. So he definitely knows his way around Washington. He knows how the Fed fits into all that.
Right.
I would say he'll take a more conservative view of market volatility up and down.
Very good. Well, the housing market is it's a big part of our economy. The interest rates go hand in hand with, a lot of people would think, well, Josh, if the interest rates continue to go up, is that going to affect the housing market? What's kind of the current shape of the housing market? I mean, you have all these dynamics, too, and I'm not sure. You have the home affordability. You have, a lot of people are talking about the millennials now. It's kind of funny, us old folks, the baby boomers now, they're kind of, okay, you guys, out of the way, time for the millennials to come in. You hear more and more about the millennials. Housing's not that important. We want to buy a home. But I remember our generation is one of the first things you do, right? You want to work and buy a home. Give us kind of the state of the economy on the housing market, if you would.
I'm going to tell you a little funny story about our new building.
Okay.
Fannie Mae is moving downtown into the District of Columbia into a new building that's being constructed. And on the top floor, it has an area where you can hold receptions and things like that. So some of us have branded that the Millennial Observation Deck, so we can go up there and watch all the millennials milling around and see if we can
keep an eye on
them.
them.
Right.
Yeah.
Housing is doing well with a couple of exceptions.
Okay.
One of them being that it is supply constrained.
Mm-hmm.
Now, we started talking about that almost 4 years ago.
Right.
Because our observation and what the millennials were telling us was different than the stories that you were hearing in the press about them wanting 300 square foot apartments with amenities, and they didn't want a house. We started surveying 1,000 households a month in June of 2010. All that entire time period, the millennial age group was saying, we are eventually going to buy a house.
Okay.
But if you look back at what happened with job growth after the crisis, the geography of where jobs first grew significantly for that age group was the central city of San Francisco, San Jose, places where you cannot build a $150,000 or $250,000 starter home.
Right.
You simply can't build it there. So if they wanted to work there, their options were apartments nearby or somebody's basement or something like that, right? That didn't mean that's what they wanted. They wanted the job, because if you ask them, what's the hurdles to buying a house? First thing is I got to have a job. Second thing is it has to have income growth prospects. Third thing is I got to get my credit in shape.
Right.
Fourth thing is probably I'm going to get married and have a baby, and then I'm going to buy a house. And they're doing that now. For 3 years, the share of new formed households among millennials that are renting has been falling, and the share that are buying has been rising. So they are now driving the demand curve. Part of what's going on is the job growth has spread out across the country into some of those secondary cities where you can actually build an entry-level house. And guess what? When they're doing it and their job is there, they're buying a house.
Yeah, very good.
It was my understanding that millennials weren't interested in long commutes either. They wanted to live, work, and play in the same space. And, you know, prior to that, people were willing to drive 2 hours to work.
Well, I think that makes a lot of sense if you're not married, so that you want the social interaction. It's easier if you don't have to have that travel time back and forth. You don't have a commitment to other people to provide housing for them or for kids. You don't have to worry about schools. Makes lots of sense. And so from our perspective, in the housing world, they're doing exactly what their parents did. And the parents did what their parents did. There's been no substantive shift in the desire to own the space that you live in.
Right. Geraldine, you have any questions for
Well, I think it's interesting to note that Facebook Village is being built as we speak, and they even have dog psychologists there to accommodate the millennials and their dogs.
That's if they're barking up the wrong tree? Oh, my goodness.
Good comeback.
Well, I grew up on a farm, so I'm not sure my father would have gone very far on that front.
But it's just interesting to note that millennials, they want to travel, they want to experience things, and they want to be able to work from wherever as well. I know people in corporate jobs that are working from South America for 6 months, and people are employers are accommodating that because they want to keep them on, and they're smart because of the technology bent that is, you know, they're fresh out of college or, you know, they're young, and technology is a big piece of what works here.
Yeah, and I think it's not just millennials, but I think that that employers in general have learned some things about the collaborative work styles that emerge in the Silicon Valley area.
Right.
So certainly in our new building, the structure of our interactions as staffers, very different than the building that we're in now. Very few offices, lots of windows, lots of collaborative space.
You walk into the collaborative space and you think, is there any work been done here?
That's right. Yeah, some of us old guys are going to have to adjust to that.
Yeah, that brings up a good point. We were doing a focus group a month or so ago with kind of a cross group of millennials and then the baby boomers, and it was funny, we had some Gen Xers in there too, and it came up, and I thought, you know, it's a good point. A couple of Gen Xers go, have you guys just forgotten about us? And I wonder, and it's kind of funny because you don't see a lot about that, right? Maybe the middle group in there. So I guess the reason I'm thinking about that as we're having this discussion, as you guys prepare for the future and look at housing and dynamics and hear back from, do you really try to do take that information and figure out, is it mostly like the future, or how does the current economy and what people are doing going to impact the future, if that makes sense?
Yeah, it is true that there's less attention paid to the Gen Xers.
Right.
How old are they now?
They're like right in between, I'll say me. So I'm a baby boomer, and I want to say,
35 to 55.
Yeah,
Okay.
right.
Okay.
Right.
They're the group that took the biggest hit in the housing downturn.
Yes.
They're also a smaller population group, so they get less attention because of that.
Good point.
But their homeownership rate fell 7 percentage points in the course of the downturn.
Wow.
So some of them have only just recovered their credit health, and there is a kind of a boomerang of that group back into the ownership space. And one other thing that has happened that affects them, but also the new entry-level folks, is mobility in general has been in decline for some 30 years, actually. Mobility is not well understood. First of all, most moves that take place are within county. They're not going from Virginia to Texas.
Okay.
That's a very small share of the movement. But the lock-in effect from people who got a mortgage in the last 7 years, having a mortgage somewhere between 3.25% and 4.25%, or 3 to 4.5%, means there's lots of those folks that are not turning those mortgages over.
Right.
And so one of the reasons that the existing home supply relative to our population is the lowest it's been in 30 years is because some of those households, particularly the boomers, who are also not doing what all the stories predicted.
Yeah.
There's aging
They're
in
not
place.
downsizing.
They are not. There were all these stories 15 years ago.
Right.
Boomers like to party, so they're going to sell the suburban home, move downtown, buy a condo.
Right.
I tell people I now live in Cape Coral, Florida, which the kids call God's waiting room. And if you want a good restaurant reservation in Cape Coral, wait till 7:30.
Oh my God, that's funny.
Right?
Everybody else is in bed.
There you go.
All right, well, we're going to take a quick break. We're going to come back and continue the show. This is Joe Kuchera with Real Estate Radio Live. We have in the studio today Doug Duncan, who's Fannie Mae Senior Vice President, Chief Economist. We also have Geraldine Barry sitting alongside with us. She is her and her associates are real estate experts, and we have a lot of exciting stuff coming up that Geraldine will be sharing with us in the next couple of months. So here's what we're going to do. We're going to take a quick break, and we're going to come right back. We're going to finish up the show. Stick with us.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
Getting ready to buy or sell a home in 30, 60, or 90 days? Then check out bundleselect.com to find out how you could save 20% or more on your entire transaction. Save on real estate, lending, and title. With bundleselect.com, technology and a personal concierge are at your service to save you time and money. Bundle Select's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling all of these services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. Act now, and this new model could save you money on your move, lower your interest rate, or cover your closing costs. Visit BundleSelect.com. That's BundleSelect.com.
The estimated minimum savings are based on a comparison with a national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live. Thank you for those that are following us on the Facebook feed. We appreciate that. We always take a quick break for our podcast. Today in studio we have Doug Duncan, who's the Fannie Mae Senior Vice President and Chief Economist. We also have joining with us our good friend Geraldine Barry and Associates. She is a real estate expert And over the next couple of months, stay tuned to the show. We're going to have Geraldine on. We'll be talking a lot about what she's doing. Now we're talking to Mr. Duncan about the economy. We haven't talked about rates yet. We'll get that in a little bit, I guess we did. But Geraldine, I think you had some questions about first-time home buyers.
Well, I think in terms of the first-time home buyer, they're being squashed out of the market. So how is that impacting things? And I know you do these surveys every month. How many people do you survey?
We survey 1,000 a month.
1,000 people.
Okay.
So what are you finding from your surveys in terms of first-time buyers?
Well, the traditional issues that first-time buyers have, getting their credit in shape and saving for a down payment, are still there. They're probably more intense today than in the past because supply has grown so slowly. Our estimate is that if set aside catching up for the length of the recession and the slowness of the recovery, if you just looked at the housing production per capita, we're probably 350,000 total units lower than what would be normal.
Wow.
That's all on the supply side. Those millennials are doing exactly what they said they were going to do. That's when they're capable, they're going to try to buy a house. The fact that the demand has grown faster than supply means real house price appreciation has been rising at about 4 times the long-term national average, inflation adjusted. So they face a hurdle in terms of that aspect of affordability. They've not faced a hurdle in terms of interest rate affordability, in that for the last 5 or 6 years, the average rate's been between 3 and 4.5%. If you go all the way back to World War II, all the way out to the crisis, the average 30-year fixed-rate mortgage was actually about 6.5%.
Right.
If you take out the very high 5 years or so at the end of the 1970s, it's 6%. So we're still 150 basis points away from that. Now, the thing that causes a problem for the market, the housing market, is if those rates adjust rapidly.
Right.
Because household incomes don't adjust that rapidly.
Yeah.
So that's where there would be a disconnect.
Well, I'm going to spend a little time on technology and how you see, we talked a little bit about during lunch today, a little bit about technology from your perspective. I mean, you work directly with the lenders, you have the consumer's expectations, and all these things going as fast as possible, it seems. But traditionally, lending, real estate, the dynamic, we've been kind of entrenched in these old ways and the way we do things, regulation, compliance. Talk a little bit about how you see that. I mean, are we prepared? Do we see some activity in that area? What can we expect maybe on using technology to improve the consumer experience?
Well, that's been a discussion point the entire time I've been involved in the industry, which is over 25 years. I would say that real change is probably only underway for, say, the last 5 years or so. And so from the consumer's perspective, you have people like Zillow and Redfin and some other startups that are consumer-facing but focused on the house and how can you understand houses and things like that. And then lenders have realized in many instances their competition is not the lender next door, it's Apple, because they've created a great consumer experience, and they're expecting that now from their financial services providers. So the share that have moved from online to mobile has picked up substantially, and the share that want to go to mobile is even higher. That's going to be consumer-facing, but it's also going to find its way through the whole process. Can I do my home mortgage on my iPhone? And so in recognition of that, one of the things that we've done is try to reduce the time between application and close for a mortgage. So our target is to go from 70 days to 10 days. Well, there's a lot to be done in that interface because of all the consumer compliance and consumer protection things that govern each stage of the process. So you can make some changes, but you got to be very careful that they apply equally to all groups, all borrowing groups, that they've met safety and soundness, identity protection. All of those things have to be built into the process. It's time-consuming, but there's progress being made.
That's a good point, what you just said. And what's interesting is, because everything is happening so quickly with the consumer interface and Amazon, and we go on and on, so automatically you're saying, and it stands to show, really, the consumer is saying, well, wait a minute, how come I can't do this, right? So now we're all speeding up trying to figure out how we obviously meet those needs, but there's a lot of regulations, a lot of things that go behind the scenes that they don't understand that have to be addressed.
Yeah, and in a way they shouldn't have to understand. It's sort of like some of the complaints about computers. With a radio, you flip the switch and it's on. It's right there, right?
Right.
I haven't seen a computer where you flip the switch and it's on. Yeah. It takes booting this
Passwords
up and this kind of stuff. Well, yeah, the mortgage is a long ways from that.
Right.
But we're working on it.
And that space is being disrupted in a lot of ways. The title companies, the mortgage companies, all the pieces of the pie are now being scrutinized by Wall Street to see how they can participate and garner some of that profit.
Yeah, and there's a lot of interesting things that are happening. You take, for example, the appraisal space. Now people are using drones in their appraisals because you can geoposition a drone so you can know the exact boundaries of the property. But you can also fit a drone with an infrared technology that's actually better at spotting leaks in roofs than a visual inspector, because it can look through to see where the heat maps and things are. So there's lots of each of the segments of the mortgage space probably have somebody attacking how to make that more efficient.
Yeah. The last piece of that, so how does the government agencies, Fannie, Freddie, I mean, how do you we talked a little bit, do you partner, do you invest, do you kind of just figure out how those pieces come together and work together? Because you're talking about some industries, big industries, and then government. How do you come together? Because we got to work together, right? I mean, yeah,
and there's if there is regulation affecting a particular portion of the process, that has to be addressed.
Right.
In some cases, it may take a legislative change, maybe at the state level, maybe not even at the national level. States have laws, and so do some local jurisdictions. So you have to be mindful of when you would need to go and attempt to accomplish those things to improve the efficiency of the process. We, at Fannie Mae, our approach is to try to partner with people who are startups. They have an interest in working with us because they can test some ideas, because we have lots and lots of data, a long history in the space. It's access to something to test some of their ideas. And so we run some pilots with startups that would affect different things, sometimes internal. We've brought in some new analytic tools into the company that were made available through some startup activity, making us more efficient internally. And as we're more efficient internally, we can pass some of those savings on to the lender partners and the consumers.
Do you ever ask questions based on maybe needs or technology that they're bringing to the table? Or how do you decipher what questions you ask when you do these large surveys monthly?
Yeah, we definitely ask on the consumer side. I mentioned earlier that we asked who was going from computer online to mobile. One of the interesting things there is that you'd be surprised how fast the boomers have moved to mobile. Now, they've been through the mortgage process before, so they actually know something about the paperwork.
Good point.
Whereas if you're a first-timer, you might want somebody with you because it's a big transaction. Right? That was an interesting thing. Another thing about the mobile side is if you are a low-income household, you almost certainly will have an iPhone, but you may not have a computer. And so access to credit for low-income households may actually have been accelerated by the iPhone, which is something they're going to have anyway, but gets multi-purpose. In another area, one of the things that we're looking at is people are now earning income from assets they already own, like a car. So they're taking the kids to school and on the way back giving somebody else a ride through Uber or Lyft. Well, what do you do with that income? That's an income to the household. Have we adjusted underwriting standards for mortgages to reflect? So we're looking at that. Same thing with Airbnb. How do you treat this person already has a house? They've demonstrated a long period of successful renting out this room. It's added this much to their income. It appears to be a sustainable model. Should you use that in underwriting a mortgage if they want to go to a different house? And they say, we're going to do that again. These are interesting questions that are raised by some of the innovation, which the industry's never really dealt with before.
When they say that robots are taking over so many jobs, but then other jobs are being created.
That's
then you have the self-driving cars on the horizon. So it's Silicon Valley.
It's a balance.
It's amazing.
Well, the self-driving cars raises an interesting question, as does Amazon, for home builders. So some home builders are now thinking about whether the garage should actually be outfitted modularly. So when someone no longer has a car, but they simply summon a car, you don't need a garage, right? It just shows up outside your house in the street. You hop in the car and you go off. So changing the construction standards, maybe leading to more dense population of housing. Likewise, do the streets need to be as wide if you're not parking on the street, but instead you're simply summoning a car? From an Amazon perspective, some of the builders are now building in secure package drop locations.
Right.
Oh yes,
Right.
you can put a lock on your door now where they can open the door and put the package in, and it's all captured on camera. I've been looking at that.
There you go.
Myself.
Yeah.
How closely, Doug, do you work with the National Association of Realtors? As I'm thinking about this, I mean, obviously, they're a big lobbying body, and there's the huge entity there. They're always interested in obviously home ownership and progressiveness in that nature. Do you guys work closely with them, or from time to time? How does that?
Well, we certainly maintain good working relationships with them, but by law, we don't lobby.
Okay.
We are prohibited to lobby, so from our perspective, we don't involve in that side of things. That all runs through our regulator.
I see. Okay. Geraldine, anything else you have for Doug today?
Well, I was just wondering what you see nationally, what markets look interesting in terms of having affordable housing and that have economic drivers that would draw people to them. We know Texas has kind of exploded in the last few years, Dallas-Fort Worth.
Yeah, we probably need to repeat this study, but I did a study a few years back that looked at the volatility of employment in local jurisdictions. As it turns out, there are some categories of employment that are pro-cyclical. When the economy is accelerating, they could create additional job growth. But when it decelerates, they actually drop jobs faster. Some are counter-cyclical, so that when the economy slows down, those jobs actually pick up. And then there are some that are not affected by cycles, things like universities and hospitals, medical care, things like that. They're fairly constant, low volatility. So in markets which have a substantial component of those universities and medical care, whatever other ones, are not affected by cyclical turns. Those tend to be pretty stable housing markets. The ones which are pro-cyclical, then you want to look into those and see how does it perform over the cycle. Is this a new job growth category, or is it one so that it doesn't have actually a test that it's gone through cyclical, or is this a traditional one? You'd want to know those things before you invested in those markets. Obviously, a couple things that are at risk today is if your market is heavily conditioned on trade, with all the discussion, the risk premiums around employment in the trade sector, is something that you'd want to be mindful of. I think
and
also
trade embargoes.
Yeah, those things are absolutely...
They're wild cards.
Sure, that's absolutely a wild card, and you would want to be mindful of that. There's a potential, depending on how the negotiations with China go, they're a big agricultural importer, so it's possible if there were significant tariffs that change the dynamics of the ag sector, that's more of a Midwestern kind of concern. So those are the kind of things you want to understand. What's the dynamic of that employment category and how important is it in that local market?
So you're not going to say any specific market. Is that what I'm hearing?
Well,
did you notice that?
That's what you're going to hear.
Good.
That's exactly what you're going to hear.
Cleveland.
That's because he's a good economist.
Detroit. Houston.
He represents all 50 states.
Oh, you're such a Washington insider, Doug.
No, if I was a Washington insider, what I would have done is I didn't like that question. I'd have just answered another one.
You'd have tweeted something about me.
That's a good time us to finish up here. It's thank you very much for tuning in, Doug. Thanks for your time, Geraldine. Thanks. It's been a great show. Always good to have you on, Doug. Hopefully, we're going to have you back in a couple of months. Give us an update. This is Joe Kuchera with Real Estate Radio Live. Thanks for tuning in. Thanks for tuning in on Facebook. And for those listening to the podcast, thank you very much. Again, for more information, you can go to RERL-1500-Understanding. Thanks again. Take care. Until next time.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.